Hello learner, welcome to Equity Investment Analysis. We'll still be continuing with private company valuation, lesson 2. This time round, we will look at the following questions. May 2018, question 2C. November 2016, question 2B. And we'll complete this session, this lesson, by looking at question 5B, pilot paper question 5B. So we start by looking at May 2018, question 2C. It reads as follows. Caroline Anyango, a certified investment and financial analyst, has been provided with the following information relating to two private companies for analysis. Company A, the working capital, 400,000, non-current assets, 1.6 million, normalized earnings, 225,000, required return on working capital, 5%, required return on current assets, 12%, growth rate in residual income, 3%, discount rate for intangible assets is 18%. Company B, the risk-free rate, 1%, equity risk premium, 6%, beta is 1.5, small stock premium, 4%, company specific risk premium, 1.5%, and industry risk premium is 1.2%. Required. Using the excess earnings method, determine the value of company A. Part 2. Estimate the required rate of return for company B using expanded capital asset pricing model. Part 3. Calculate the required rate of return for company B using the built-up approach. So we will now start off looking at 2018 question 2C. Then in part 1 is asking the excess earnings method determine the value of company A. Value of company A. So first of all, we need to identify the return on working capital as well as the return on fixed assets. So how are we going to do that? We will first of all get the working capital rate. So return on working capital, return on working capital there. So working capital balance is 400,000. So 400,000. You multiply that by the required return, which you're seeing is 5% on 400,000. So how much are we getting? So we get this value, 400,000 multiplied by 0.5, 20,000. Yeah. Then we get return on fixed assets. In this case, we're saying non-current assets. So into brackets, non-current assets. That. So we have the non-current assets value given to us. Non-current assets, we're saying is 1.6 million. Like that, multiplied by the required return on non-current assets, which you're seeing is 12%. Like that. How much are we getting? We get, so we have 1,600,000 multiplied by 12%, 0.12. 192,000. 192,000. Now what are we saying? We'll be getting the value of residual income. To get the value of residual income, we can be able to say residual income. That. Move over on this other side. We have the normalized earnings of 225,000. Yeah. We less the 20,000. Then we less also 192,000. Like that. How much are we getting the residual income? So 225,000 minus 192,000 minus 20,000. 13,000. Once we have this 13,000, we discount this using the required return on intangibles, so that we can be able to get the value of intangibles. So we're saying we have 13,000, 1 plus the growth rate of intangibles. The growth rate of intangibles, we've been given, the growth rate of intangibles is, no, sorry, not the growth rate of residual income, 3%. Then now I meant to say now the discount rate of intangibles is 18%, 0.18 minus 0.03. So that we can be able to get the value of using the excess earnings method, the value of intangibles. So how much it is? How much is it? Half for 13 multiplied by 1.03. We have 13,000 divided by 0.1
everything I do so instinctive and so passionate.
minus
Every word I move so descriptive like an adjective. I got a vendetta against people who patented being negative when you should be getting after it.
The entire answer.
I got facts over tracks. This and that, spitting slow, spitting fast. I can roast, I can gas, think I'm okay at last, but I don't know if that can erase all the past and the pettiness. A reflection of the emptiness, hilarious. You think you're worth my time, you're delirious, mysterious, because you are behind a fake exterior, inferior. You know I'll always be a bit superior. Get off of me, this ain't no humble
That is
brag.
the value
I
of
want you to hear words.
Get
you can say
now
it back.
the
I want
value
you to
of the
feel
farm.
free from the chains that last, and
The
to
market
believe in
value
what you got. It was built to
on the
last.
value of the farm. You're saying you will get, we have following values. We have the normalized, the working capital balance. We have 400,000.
I don't ever slow up, no I don't take shit. I got no
Then we
love
add
for the fakeness.
now non-current assets, 1,600,000. Then go ahead and also add the 89,000.
If you wanna play tough and wanna hate this, I'll always show up and make a statement. Gonna learn the consequence of being incompetent. Mental health is confidence, dreams and some honestness. I'm not here to say
89 to 66.67 plus 400,000.
something that is topical.
Yes,
Rub it on and watch
then
it go.
plus
Make yourself unstoppable.
1,600,000.
Future irresponsible, but they're always possible. If you just believe, you could be
Get
so
2
remarkable.
million.
Thoughts in my head, a collage and they spread. I'll be great one day, going off of my meds. No, I'm not giving up. No,
That
I'm not
is the
giving
value
in. I will
of
make it to the top,
company
taking
A.
off in the wind. I gotta make it. I'm saving every day to taste it. I'm patient, but my mind
Now
it can
part
hardly take it.
2
I'm
of the
chasing
question
a
is
dream that I've
asking
never
estimate the
celebrated.
required rate of
Vacant.
return
Modern
for
kingdom
company
for the
B
taking.
using the expanded capital asset pricing model. Two. Expanded capital asset pricing model. To brackets expanded CAPM. risk premium was 6%. 6% multiplied by what? Multiplied by the component of beta of 1.5. That. Then to that, we are saying we will add the component of small stock premium 4%. Then we also go stock premium. Then we can continue to look at CSP. CSP company specific premium. That, and finally IRP is industry risk premium. So we start off with RF. So we have 1% plus 6% plus we have small stock premium of 1% plus we have 1.5% of company specific risk premium, 1.5% plus we have 1.2%. So we have 1% here. This is 7%, 8%, 9.5%, 10.7%. That is the required rate of return for company B using the built-up approach. Now we move on to November 2016 question 2B. It reads as follows. John Odhiambo, an investment analyst at Kobler Capital Limited, has gathered the following information relating to private company that he intends to analyze. You have the risk-free rate, beta of the company, you have equity risk premium of 6%, and the beta of the company is 1.5, small stock premium, if I can read that again, the permission, it reads as follows. Risk-free rate 1%, beta of the company 1.5%, equity risk premium 6%, Small stock premium 4%, company specific risk premium 1.5%, industry risk premium 1.2% required. The required rate of return of the private company using capital asset pricing model. Part 2, the expanded CAPM. Part 3, the build-up approach. So we state the question first. So it's November 2016 question 2B. That. And we start off by looking at part 1, capital asset pricing model. Capital asset pricing model. CAPM. We have RF plus RM minus RF beta. Where input RF is then RM return on the market on beta systematic risk. RM minus RF is equity risk. So we have CAPM RF plus RF beta. RF, what do we have? 1% plus. Do we have the equity risk premium? Yes, we have equity risk premium. We're saying 6% multiplied by the beta. The beta we have been given to us as 1.5. 1.5. So how much is our CAPM value? We have 0.06 times 1.5. Now 0.09 plus 1, we're saying is 10%. So that is 10%. 1% plus 9%, 10. Part 2 is asking what? The expanded CAPM. 2, expanded CAPM. So for the expanded CAPM, we will be able to, first of all, on top of this capital asset pricing model value, we will be able to add small stock premium as well as company specific risk premium only. So we're saying we have CAPM plus small stock premium, plus now we are saying the company specific risk premium, company specific risk premium. Moving over on this side, we have it as follows. So we see expanded CAPM is equals to how much? So we are saying we have the 10%, which we calculated over there. And the small stock premium is how much? We're saying is 1.5%. Then on top of that, we need to add company specific, that's company specific premium. This is company specific premium. And then the small stock premium is 4%. How much do we have? We have this plus this is 14%, plus this is 15.5%. Saying we have 15.5%. That is the expanded CAPM required return. Now, we look at the build-up approach, part 3. Build-up approach. That is expanded terms of up approach. There. Now, the build-up approach, we start off by having the risk-free rate of the company, which you're saying is 1%. So RF plus, we need to add the equity risk premium, ERP, plus we add the small stock premium, company-specific premium, and industry-specific premium. So company-specific premium plus industry-specific premium plus small stock premium. That. So where? I don't know, we had already explained this before. So this is the risk-free rate, this is the equity risk premium, this is the company-specific premium, this is the industry-specific premium, plus the small stock premium, like that. So we are saying we get the risk-free rate as how much? 1%. Plus the ERP, or the equity risk premium, 6%. Plus, we are saying the small stock premium is 4%. Plus, we have the company-specific premium as 1.5%. Plus, now the industry risk premium as 1.2. 1.2, like that. So how much do we have? This is 1 plus 6 is 7. 7 plus 4, 11. 11 plus 1.5, that's 12.5. So 12.5 plus 1.2, we have 12, that's 13.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.